Thank you all very much for being here for the educational seminar. This is number 1, hosted by Tax Goddess. Absolutely thrilled to be here with you guys today. So my name is Shauna, the Tax Goddess, and today we're going to be covering the 2018 laws that you can still do something about, even though the year of 2018 is now over, as well as the 2019 changes that you should be paying attention to, because of course we're now in 2019. So this is me. I am ranked in the top 1% of tax strategists in the country by the AICTC. So out of 660,000 CPAs across the US, I am in the top 1%, and I love it. Absolutely love it. Strategy is my game. I love it. It's way too much fun. As you guys can see, I've been featured CNN Money, CBS, NBC, Fox, published author. You'll hear me talk about this all over the place. Tax with Jedi, you'll hear me talking about fighting against the dark side, okay? Do you guys have any guesses who the dark side is?
The government.
The government, right? All about trying to help business owners make sure the business owners are saving their money. And of course at the individual level too, right? Because you can have a small business, a side business, and it still counts as a business in the eyes of the IRS. It's one of the things that I love about the US tax system. I'm originally Canadian. The Canadians have no tax deductions whatsoever. Being an American, you guys are lucky. You guys have some of the best tax deductions in the entire world, which is fabulous. So, a live Q&A, guys. I want to answer your questions. So, if you guys have any questions whatsoever, just shout them out, pause me, whatever. I love being interactive, so we'll try and keep it on time. So the major tax reform that happened in 2018 was called the TJCA, okay, Taxpayer Job and Cuts Act. That was the most large, that's not helpful, the largest tax reform since 1986. Over 60% of the tax code changed. Wow. 60% changed. So massive changes. One of the things that I love about it, because there were a lot of people that were really panicked about, oh, there's so many things changing, and is this good, is it bad, what's going to happen? If you are a business owner or if you're an investor, this is huge. Get one. Okay, you have to have a business under the current tax law to get the benefits that you need. Now, one of the main changes, or one of the main issues here, is that a lot of these positive changes are going to revert. It's called sunsetting in 2025. So, if you're going to go after the tax savings that you get as a business owner, do them now, do them fast, fast before 2025, right, before they start to revert. So, these are the main topics we're going to be covering today. So, a summary of the changes for businesses and owners. What should you consider as far as your business entity type? So should you be an S Corp or C Corp or an LLC? QBI, this is one of my favorite new pieces here. This is a free 20% tax deduction for all business owners. Free. So we like 20% off, right? That's really cool, but you gotta meet some requirements there, so we're gonna go over those. There are some depreciation changes for investors out there, as well as some of the things that you're allowed to expense, not expense, net operating losses. So if you have a loss in a business, how does that work? And of course, 1031 exchanges. This was actually a really big change in the law, but we'll go over that when we get there. So let's start with the business changes. So one of the major ones, both on the individual level and on the C corporation level, so at the corporate level, the US government, this change gave tax rate reductions, okay? Now, at the individual level, the highest tax rate dropped from 39% to 37%. So 2% change, I mean, it's still 2%, I'll still take 2%. However, as you can see here on the C Corp side, we're actually dropping from 35 to 21. Massive tax reduction, okay? Now, where this really comes into, and this is not one of the ones that's going to expire, unless, of course, they change all the rules again, right? This one's not going to expire. One of the areas that this is really helpful for are people, the owners of the C Corporation, if they have major medical expenses. So if there's cancer, if they're uninsurable, if whatever, right, major medical expenses, C Corporations can be really good. Or, of course, if your personal tax rate is at the 37%, 21 sounds pretty darn good, right? This is some good stuff. So using a C corporation as part of an overall strategy can really help you reduce the overall family or the overall group tax rate across the board. So taking a look at, should you go to a C corporation, if you're an LLC, if you're an S corporation, should you go to a C corporation, is a calculation that you're going to want your CPA to do for you, or somebody who's an expert in these new tax changes for sure. So, the great bit about it, we talked about the 21 versus the 37%. The other pieces that I absolutely love about C Corp, so you see MERP down there in the bottom left, that is a medical expense reimbursement plan. So again, major medical costs. Do you like athletic facilities? Do you want to build a pool in your backyard? Would you like to write off your massages? These are things that you can actually do as a business expense if you own a C corporation, but only in a C corporation. You cannot do it under any of the other structures and get the same kind of benefit if you're an owner, right? And typically, if you're going to pay for massages, you want them for you as the owner, right? So please, go ahead.
I'm familiar with LLC. Can you explain what a C Corp and the other Corp is?
You got it. So there's actually two different sides to entity formation, to having a business. So there's the legal side and then there's the tax side.
Right.
So on the legal side, an LLC is a form of legal entity. You also often will see partnerships or Incs, incorporated entity, or no entity at all, right, which is often called disregarded. So on the taxing side, you can have a C corporation, an S corporation, a partnership, or a sole proprietorship. And so the C Corps that we're talking about here can either be, for example, an LLC taxed as a C corporation, or an Inc. taxed as a C Corp. So there's multiple choices, and depending on the rest of your scenario, it would determine whether you should have this type of legal or that type of tax. So great question, thank you. Any other questions on this one? No? Okay. All right, so the QBI, this is the big one. Everybody, this is that free 20% that we were kind of talking about on that first slide, all right? This is huge, but QBI, this is how the government basically said, well, listen, we gave a massive tax deduction to those C Corps, right? We took them down from 35% to 21%. It's not exactly fair for all of us flow-through people, right? Us S-corps and partnerships and sole proprietorships, we are what are called flow-through, okay? So in order to try and make it a little more even, the government gave this, which is the QBI, it's the Qualified Business Income Tax Deduction. Now the maximum amount that you can have is a 20% deduction for any pass-through, flow-through entities. So again, your sole proprietorships, your partnerships, your S-corporations. But in order to get that, you have to meet some certain requirements. Okay, so we're going to go over those requirements. One of the major ones, and they actually added this later in the law, is that if your income does not go above, for a single person, $157,500, and for a joint couple, $315,000, you automatically qualify for the 20% flow-through deduction. So as long as you can keep the rest of your income below that limit, free 20%. We all love free 20%, right? This is good stuff. So what are you really seeing here? What you're seeing is companies that, let's say, for example, your business is making $500,000 a year. Well, you're married, but you're still way over the limit, right? You're over the 315, okay? So the main company will split into two pieces. It will set up a C corporation to house half of the money, $250, and the flow through for the remaining $250 will come to you. You'll be under the tax limit, and now you get your free 20%, right? So there's lots of really cool games that you can play, all above board, all legal, not doing anything wrong, but lots of really cool games that you can play and still follow the rules of what you need to do to get the tax deduction, okay? So let's get a little more into detail on this, all right, on the QBI. So we talked about the phase out limits. You can see there, 157 for single, 315 for married. As your income goes up, you start losing the tax deduction, all right? So if you're single and you're going from 157 to 207, 500, right? If you get to 207, 501, your 20% is gone completely, right? So you better find one more dollar worth of deduction, right, to start getting under that limit, all right? Now, the difference between the 157.5 and the 207.5, that is where it starts phasing out. So instead of getting 20%, you might get 18% or 15% or whatever, 12%, whatever it is, as you get closer and closer to that limit. Now, if you're above those limits, all right, so you can see down here at the bottom, they've given some specific qualifiers for service businesses, all right? So if you are the principal, you are the business's principal asset is the reputation or skill of one or more of its owners. So typically these are like consulting firms, doctors, architects, lawyers, right? There's some specific things. These guys, good or bad, they get no deduction, unfortunately, if you're over that limit, okay? Except for the architects and the engineers, because they had an amazing lobby, right? That was it. So they got their lobby. The rest of us, Porschmos, service businesses, if you were over this limit, does not qualify. So we are starting to see, again, multiple, you might have one person earning all the revenue, but they're splitting it into multiple companies. They're bringing on partners, they're bringing on spouses to move money, they're doing married filing separate, there's a lot of planning and moving with relation to trying to get this tax deduction. Because 20%, if you're making enough money, let's say you're making the $315, 20% of that is a $60,000 tax deduction at the 20% bracket. You've just saved yourself $12,000 by opening a new company. Could make sense, right? So it depends on who you are and what you're doing. Any questions on this stuff? No?
So if you had an owner that was approaching the 207,500, how would you advise them to take income differently?
You got it. Well, the very first thing that I would tell them to look at is, are you actually properly reporting all of your expenses, right? Because the income is the very, very, very last number in the entire chain of a profit and loss, right? And really that's what that number is representing, is your taxable income.
Sure.
So if at the very beginning you can push income from one year to another year, if you can increase your expenses by maybe paying your children or doing one of my favorite things is the master's exemption rents, which we'll talk about a little bit later. But if you can get additional proper and all legal and above board business expenses into your business or into the income before it hits your tax return, of course then you can get it under. But if you've done everything you can possibly do, right, and there's no other option, the next best thing would be potentially a C corporation. We're talking about retirement options, right? I mean, if you've run through kind of your normal deductions, start looking at some of these other strategies that are a little bit outside the box besides just buy some more equipment, right? Yeah, because I'm a big fan of keep your cash, right? There's no good reason to give your cash to somebody else, unless, of course, you decide to open your own equipment financing company, which is a whole different issue, right? But lots of different ways to move money if you can get close. It's worth trying. So
Get creative but legal.
exactly, yeah. One of the biggest things that I find that business owners don't really understand when you talk about tax strategy is that when you hear tax strategy, you hear, oh no, I'm doing something that the IRS doesn't like, right? And it can be a very scary thing, which is not true at all, right? This is exactly where I started, right? The Canadian government basically says, you make this much money, you pay this much tax. No choice, that is what it is. I mean, there's a couple of deductions, like 3, okay? The American government, on the other hand, the tax code, before it got changed, was over 6 inches thick of Bible paper in print, in like size 6 font print, okay? There are deductions and options and ways to move money, and this is all above board, right? This is how we hear business owners paying 2% tax, right? Using capital gains instead of ordinary income tax. So, big fan of finding all the strategies, pay the minimum you can, but all legally all above board, right? Okay. Great question, thank you. Any other questions? No? Okay. All right, so QBI, if you are a non-service business, and this is again above the limit, right, above that 315 limit that we were talking about for a joint couple, if you are a non-service business, this gets even more complicated, okay? Now you're looking at a deduction which is the lesser of 20% of QBI, right, which is that calculation, that income calculation, or the greater of your W-2 wages. Now this is where we start building spreadsheet after spreadsheet after spreadsheet, okay, so you definitely, again, want a professional running these numbers for you, but it brings up a perfect example. What if you have a business that has both service and product, right? Does it make sense in that case to split the businesses? This is my service business, this is my product business, to be able to qualify for the QBI under the product side. You know, how can you really move those income numbers? So if, obviously at this point, today is January 17th, 2018 is done and over with, but 2019, you now know what the rules are. We've already started having court cases on these things, on the QBI deductions, because there's a lot of little loopholes that people are going in and out of, right, trying to do what they can. So we're starting to get more and more very clear-cut court cases. How is this going to work? What is it going to do? How do they make decisions about this information? So, cool. Okay, so splitting the revenue streams, clarifying your income and your sources, and of course, as we said, getting all the write-offs to get below the limit, right? Okay. All right, depreciation. So this one is really, really important, especially for real estate owners, investors, anyone with any kind of physical property or equipment. So construction companies with big cat machines, those kinds of things. They did raise the 179 limit. So 179 means that if you have profit, you can write off the entire purchase price of the asset in full. It used to be $500,000, it's now $1 million. And of course, they've also continued, kept the bonus depreciation. They did change it a little bit. Bonus depreciation, 50% off in the first year, used to only be available on certain types of property. They've now made it available on all property, which is really nice. Okay, so if you buy something small, like for a smaller business, let's say you buy a $3,000 Apple PC, right? $2,500 is the new cutoff for whether it's an expense or whether it's an asset. So it's a $3,000 PC. Because assuming you have profit, you can write it off under the 179. If you don't have profit, right, you've done such a good job tracking all of your expenses that you don't have any profit, you can still get bonus depreciation of 50%. So it's putting you further and further into the hole, which is, from a tax perspective, a good thing, right? If you had to buy that computer anyway, might as well get the tax deductions for it. Now, a couple of pieces specifically for real estate investors. Qualified improvement on property. When you owned a commercial building, depreciation used to be over 39 years, right? They actually have now allowed you to go down to 15 years. So if you're an investor in real estate, one of the biggest things that you can do for yourself is to get what's called a cost segregation study, especially on commercial property. And really what that does is it tears apart the building. So if we were to look at the building we're in right now, right, we see there's flooring, there's shelving, there's drywall, there's electrical in the ceiling, right, there's wiring, lighting, all these things. When you're talking about cost segregation, normally when somebody purchases a building, they basically say, okay, I bought this commercial building for $1 million, and so I'm going to take $1 million and allocate a little bit to land. We'll put $200,000 to land, and the $800,000 remaining will be depreciated over 39 years, okay? 15 is a heck of a lot better, right? It means that you're recapturing your expenses a lot faster. And if you go with a cost segregation study, you can actually take apart, flooring becomes 7 years, electrical wiring becomes 7 years, drywall is 10 years, okay? Wood, which can be destroyed very easily, could be over 3 years. All right, so you can really, really pull it apart with these engineering studies. They're called cost segregation studies, and get much better tax deductions than what you would have normally had just as a 39-year, here's my $800,000 building, okay? So cost segregation studies also work really, really well even on residential rental properties. So I know earlier I was talking to one of the fabulous people here today, and she was saying that she's turning one of her properties into a residential rental. So what you can do, especially if it's going to be a long-term rental, it normally doesn't work so well if it's only a few months in this strategy, but if it ends up becoming a long-term rental, I'd say for more than a year or two, you can actually obtain cost segregation studies on residential rentals. And those studies, they used to be about $5,000 for the study because they would fly out teams of engineers from California, right? You can now get commercial cost segregation for about $800, and you can get residential for about $295.
Wow.
Yeah, so if you're in real estate, this can really, really bring you a ton of tax savings. I mean, massive amounts of tax savings. and the prices have come way, way down, so you're not out of pocket a lot right up front.
Can you write off the cost segregation?
Yes, sir, absolutely, because it's a part of running a business, right?
Right.
If this is your business, is to be in real estate or in property, anything related to that business is a tax deduction. So, great question. Cool. What else? Anything else on this one? No. Okay. Fantastic. So let's go to business expenses. This one killed me. I was so sad when this one happened. So we have all heard, anyone who's been alive since 1986 has heard the term meals and entertainment, right? That is the deduction, meals and entertainment. They took away entertainment. You can no longer deduct entertainment. So, for a lot of smaller businesses, what would happen is that, you might buy season tickets to a basketball game and then take your clients with you, as a client goodwill kind of gesture. Entertainment, not deductible, not allowed. I mean, you can still buy them, you just can't deduct them for tax purposes, okay? Now, meals, you're still good. They left meals alone, and the meals, the big thing, yeah, we're all smiling, we all like food, right? Food is good stuff. So one of the things that I am happy about is they did leave, there were actually 3 separate meals categories, and not a lot of people actually know that, okay? So you have your 50% meals, which is you're taking out that client for dinner, you're trying to schmooze them. I call it the schmoozing meal, okay? So the 50% meaning that you're only going to be allowed to deduct 50% of whatever the cost of that meal is, period, okay? Now, on the other hand, and you'll kind of notice it's thrown in here up with the staff, office holiday parties are 100%. Now, in this case, that allows for entertainment expenses because it's a part of a company, so you see office holiday parties. It's you and your employees, company only, okay? This is still 100%, and yeah, I'm hearing the wheels clicking in the crowd. I'm loving it. We're gonna get to that. So this covers this, so you've got the 50% meals category, you have the 100% meals category. 100% meals is the food, the money that you spend on food, on meals, for your staff so that they work longer, they work harder, they stay with you, right? It's like an employee benefit, okay? Now the really cool bit about this, and this is why I keep pointing to this entertainment expense, all right? If your spouse happens to work with you in your business, your food is now 100% tax deductible, okay?
On the office party,
On the office party, yes.
holiday party.
Yes. Now, so we get people that go way too far the other end. Okay, yeah.
So
I'm
you know
going-
where I'm
I know
going.
where you're going
What's
with
the
this.
definition of a party?
What's the definition? All right. So let's talk about that. Okay. The biggest thing, one of my favorite statements that anyone has ever said to me ever, okay, is that pigs get fat and hogs get slaughtered. Okay, and how that relates to this, I have seen cases where clients say, well, yeah, my spouse is my business partner, so every grocery bill, every meal out, 100% of everything we do falls under this. No, you're not talking business with your spouse at every single, like you're eating a snack bar and you're talking about, oh, we should buy some office supplies. No, you're not, okay? And the IRS knows that, all right? So don't be the hog, don't get slaughtered. It's all good if you get a little fat, right? If you have a business meeting once a week or once every 2 weeks with your business partner, that is reasonable. That is something that you would do in the regular course of business, whether it is your spouse or somebody else, right? You might go out once a week to talk with your business partner about whatever.
Of course, that's going to be the most expensive meal.
You can do whatever you want, right? The IRS doesn't have any qualifications on that.
Right.
They just say that if it's for your employees, if it's for your staff, it's a 100% business meal, okay? So one of the things that we see really frequently is that bookkeepers, for example, if you hire a bookkeeper, or if you've never been told this and you're doing your own bookkeeping, you have no idea, right? 100% of your business meals are going into the 50% category because that's what you understood, okay? So what we recommend for a lot of people is put it into your books, and we'll go over the third category here in a minute. Put into your bookkeeping the 3 separate categories and really pay attention when you're about to pay for something. Wait, so which one is this? Is this really I'm schmoozing a client so it's 50%? Or is this really I'm out with my business partner, or should this really be a personal meal, right? If your wife happens to be your business partner and you go out for your really expensive business meal on Valentine's Day, maybe not. Let's not do that, okay? That might be a little much, pushing a little bit too far, okay? But it really does come into, can you prove it, right? Because none of this stuff matters unless you get audited, right? If the IRS comes in and audits, and all of a sudden they look and every single of your most expensive meals is the one you just happen to have with your spouse business partner, right? They may not like that too much, okay? So be reasonable about it, right? Pigs get fat, the hogs get slaughtered. It sticks out to me every time. So the third type of meal, just so I don't forget, is for travel, okay? If you are more than 50 miles away from your tax home, so if you work in a home office, your tax home is your home office. If you work in a building, that's your tax home, right? So wherever your tax home is, oh gracious, wherever your tax home is, that is if you're more than 50 miles away, sorry guys, if you're more than 50 miles away, that is what is called a travel meal, all right? And you want to track that. That is the third category.
Awesome.
Travel meals are separate, okay? So even if it's just you, right? So let's say you're driving from one place to another. We have a lot of this with the traveling salespeople, right? They're driving between Los Angeles and Phoenix, back and forth, back and forth, back and forth. They're stopping to get the $8 burrito at the side of the road because they're driving on wherever they're going, okay? That $8 meal is a specific kind of meal that goes to travel. So just make sure you keep your three categories straight in your bookkeeping.
I need to keep that in mind now that I live up there.
Now that you know, yes you do, because you live quite some distance from here.
Yeah.
Yeah. So, perfect. Okay, so in general, entertainment is no longer a deduction. However, if it's for your employees, for your staff, 100% you're good. Okay, holiday parties. Business interest, they made an adjustment here. There is a major exemptions or exception. So if your gross receipts are under 25 million, so I presume that most of the people in the crowd, gross receipts are under 25 million. But if it's not, you do have to work with your CPA to run some specific calculations. Business interest is no longer just automatically deductible, right? Really what they're trying to prevent with this is companies that are going into debt and are headed towards bankruptcy, right? They're trying to give them penalties, like don't get so much debt, okay? It's not a good thing. That's what they're trying to prevent. So, all right, perfect. Any questions on any of this so far? Nope? Okay, perfect. NOLs. This one is actually pretty interesting. So the NOL stands for net operating loss, all right? So what used to happen is that let's say you started up a brand new business, okay? And so you purchased some equipment, you bought some computers, you bought some supplies, you only had one client, you made $1,000 that year, you started your business, you made $1,000, but you had $20,000 worth of expenses to start up the business, right? So you'd have $20,000 expenses, $1,000 income, you have a $19,000 loss, okay? In the past, a net operating loss used to be able to be carried backwards against previous year's income. Because the IRS's theory was, well, you took previous income that you made to pay for those $20,000 worth of expenses, you should be able to deduct it, okay? They killed it. That's gone, all right? So you can still deduct an NOL, but now it can only be moved forward, not backwards, right? You used to be able to carry it backwards. Now it can only be moved forward, so they're trying to kill these businesses that have loss after loss after loss after loss, like year after year, right? This is no longer allowed. And you can only deduct 80% of the loss. So if you had rounded up to a $20,000 loss, right, you're only able to deduct 18,000 of that, or 16,000 of that, not the full 20, okay? So this can be a problem for smaller businesses that are starting up, because if you have a loss, you'd like to be able to deduct it, maybe you can, maybe you can't, so it's just one of those rules to kind of stick in the back of your head, that if you have a loss, you have to run some special calculations to make sure that you're good with that you can do that, okay? All right, 1031. This one, so 1031 is one of those terms that used to really stick out for real estate people. Okay, so I'm going to pick on our renter extraordinaire over here, okay? 1031, you used to be able to use this code section, 1031, to exchange one thing for something else, okay? So, for example, you can see here, we used to be able to do personal property. If I had a computer and you had a computer and we wanted to swap those things, we could do that. And there would be no tax burden, no bill, no nothing, right? It was a one-for-one trade. You could do it with cattle, you could do it with cars, you could do it with trucks, with patents, artwork, anything you want, okay? They changed this as of 12/31/17, okay, so 1/1/18, this was now gone, all right? 1031 is only for real property, that's it. So for my rental people, you're still good to go, right? If you have this rental property and you're renting it out for 10 years and then you decide, hey, I don't wanna be in residential rental anymore, I wanna go to commercial property, right? You can do that, you can still sell it, not pay any tax if there's a gain or loss on that property, and take that money and put it into something else and you're good, okay? The biggest area where this is coming up to bite people is the Bitcoin cryptocurrency people, okay? Because previous to this regulation, if I had Bitcoin and I exchanged it for Ethereum, for example, which is another type of coin, all right, there was no taxation, none. And then they put this rule in. I wonder why, because Bitcoin went from being worth nothing to being worth $20,000, right? Or 20,000 per, coin, right? So they killed it for the coin people, the digital currency people. It is now only good for real estate, okay? So something else to watch out for if you hear anybody in Bitcoin or Ethereum or any of the coins, the currencies, this was a big issue, or is a big issue, so. Perfect. All right, so you can see, yeah, crypto, right? You guys used to be able to get this, no more. Real estate, you're good. Now, there is one strategy that I always like to bring up here. If you know somebody who's selling a thing, right? So on the previous slide, we talked about you could sell an aircraft, you could sell heavy equipment, you could sell franchise tax rights, or, food rights, whatever it was. You could sell anything, okay, and use 1031. Not anymore, it got killed. But there's a strategy to replace it, okay? It's called the DST, the Deferred Sales Trust. And effectively what happens here, it's very similar to a 1031, but because you don't have control over how fast and where the money moves, you are not taxed on it. Now, not having control over your money sounds terrifying, but there are lots of pieces in there to make sure that really your money is safe and everything is good and it's all above board and all this good stuff. But what you're really doing is you're selling your property to a trust, which will owe you a note over time. And because you're the one that draws up the note, you don't have control. There's a trustee that controls the trust, but you're still getting all the assets, the money, the payouts, whatever it is from the sale of the asset. So if you know somebody who's selling a thing, right? These cryptocurrency people that it went from 20 and then it went down to 14 and then it keeps going all over the place, the values. They can sell their cryptocurrency without paying current tax. They pay tax when they get paid on the note over time, okay? So this is working really well for the cryptocurrency people, for anyone who owns a business that is trying to sell and get out of the business, anybody who's trying to sell something big that is no longer real estate, right? Because the 1031 only works for real estate now.
It's kind of like when you cash out a IRA or something, right?
Exactly, yep,
Okay.
yep, got it.
Is this a certain kind of trust, or are there limitations on what type of a trust you're talking about?
You got it, yeah. So the DST is actually a very specific strategy from a law firm out in California. They've been doing it for about 21 years now. They've had 9 audits, all of which they won, right? The one private letter ruling. So again, all above board, but it is a very specific strategy. It's not one of these things where I'm just going to set up a trust and put my stuff in it. Yeah, it's a very specific layout. It falls under Code Section 453 of the IRC, stands for the Internal Revenue Code. So happy to provide more information if you've got something.
What does the DST stand for?
Deferred Sales Trust. Yeah. So it's just kind of their name for this specific kind of thing. So perfect. Okay. Any other questions?
What would be the terms on the note? You said the seller determines that?
So if I own, let's say I own the franchise, right? I own the cryptocurrency. Let's stick with cryptocurrency. So I own $20 million of cryptocurrency, and I want to sell it, right? I've decided I want to get out of it, but I don't want to pay the tax on $20 million worth of crypto, okay? I'm going to get slaughtered. So what I do instead is I sell my property, I sell my crypto into this trust. And of course, when you sell something, you have to get something in exchange.
Right.
So really what you're receiving in exchange is a note, and I'm the seller. I get to determine whatever I want with the note, Okay, so it can be a 10-year note, 20-year note, generation skipping note, which is really cool. So don't pay me, pay my grandkids, okay? There's some really cool features that you can do within this thing, okay? But again, this is why it's such a specific setup, because if you don't do it right, if you miss even one document or one payment or one whatever, the whole thing goes and you pay tax on $20 million.
Oof.
Yeah, really nasty. So what I always like to say is with the IRS, anytime you get a good, sure, you can defer the tax. There's a bad, but if you sneeze wrong, we will slaughter you, right? Like that's just the way that the IRS works, so. Okay, cool. Any other questions on this one?
Like the hog.
Say it again.
Slaughtered like the hog.
Yes, you got it, exactly, right? Because we're trying to be greedy. We'll give you the tax deferral, but you gotta play by our rules, right? And those rules are set out in 453, in section 453, so, cool.
Could you use that for stock?
You can. You can use it for anything that you can own title to. So cryptocurrency is considered a property, right? You could use it for rental properties. You could use it for insurance policies where you're supposed to be getting a payout. We've used it for lottery winnings, right? Because these people win
Yes.
$50 million, right? And they get hit and they lose 90% of it to the tax bill and annuity payments and all this. So you can use it for that. Anything that you own a right to, something that you can sign over, you can use the DST for. So, cool. Okay, dig it. Owner's changes. So this is more on the individual side. So we talked about the highest income tax bracket went down from 39.8 to 37. So yay. One of the things that is great, it's good and bad at the same time. The standard deduction has doubled, okay? So this was in 2017, just for being alive, right? For being a person, my standard deduction was around $6,200, all right? So they doubled it as a single individual. It now goes up to $12,000. If you're married, it goes to $24,000, okay? So really what they did here, there was a lot of, you saw a lot of campaign promises about, we're gonna make a postcard tax return, right? That's a part of this, okay? That's what they were trying to do. So if you're married, and let's say you have a mortgage and you do charity and you have a little bit of medical expenses, whatever, right? Before, to get all of those deductions, you had to itemize. Now, if the total sum of those deductions, if you're 100% sure, 90% sure that it's gonna be less than $24,000 as a married couple, you don't even have to report them anymore, okay? You just take the $24,000, you're done, cuts off a lot of work off the tax return, right? It makes it a lot easier. You don't have to track anything, you don't have to keep receipts, all these kinds of things. Now, with that being said, anytime the IRS gives you a good, what do? Here's a bad thing, right? Here's some bad stuff, okay? So the personal exemption here, what used to happen is that you got $6,200 for being a person, right? Standard. And you got your personal exemption. So you were basically at like 10.3 total, okay? They bumped it to 12, they're trying to make everybody happy, okay? This is totally good and fine if you're single or it's just you and your spouse, right? There's two or, whatever. Up until you hit the point with somebody with 3 kids, okay? When somebody has 3 kids or more, now they've lost a massive amount in this personal exemption, okay? And the more kids they have, the worse and worse and worse this gets for them, all right? So we've seen clients, we have one in particular that has 10 children, okay? Yeah. She's the most amazing woman I think I've ever met in my entire life. She's a crazy mom, she's fantastic. However, their tax bill just skyrocketed because 10 times 4 is a $40,000 deduction that just, poof, gone, okay? Now, they are gonna get some child tax credits. They did increase, down here, they did increase the child tax credit from $1,000 to $2,000. So, okay, they're getting some benefits.
Still.
It didn't quite offset for them, okay? It helps, didn't quite offset for them. So typically what we're seeing when we're running the calculations is if you have 3 kids or more, this is starting to negatively impact you, okay? So the other big one, and this is really impacting the SALT deduction. So SALT stands for state and local taxes, okay? Now here, we're in Arizona here, our state and local taxes are pretty low, generally, right? Until you're making a lot of income and therefore your Arizona tax bill is really high, okay? Arizona's not really what they were trying to go after here, okay? They're going after people in really high tax states. So places with massive property taxes like California, New York, New Jersey, right? As well as typically the people in those states make a lot of money, right? Because to live, we were just talking, to live in Manhattan, you have to make a lot of money, all right? So they have capped this at $10,000. Now, even here in Arizona, okay, if you're making a decent amount of money between your property taxes, your car tax, right, and your state and local income taxes, you're hitting about 10, okay? That's kind of about where you're at, so it's not a big thing. But for people out of the state, this is a serious issue.
We'll get more of them moving here.
Yes, we will. We're going to have a lot more people moving to the low tax states for this exact reason, right? Or the zero tax states. You get a lot of people moving to Florida, to Nevada. You know, anybody that can go digital has gone digital and has moved out of a state with tax at this point. So, I'm sorry, was there a question?
No.
No? Okay. So, you know, so that's a big one, especially for higher tax states. So if you know anybody in California, tell them to move to Nevada, right? Get across the border, get over on the other side of Lake Tahoe or whatever. Okay. The other one, and this one really stood out to me, was that there is no longer what's called the 2% floor tax deductions. Now, a lot of people really didn't catch this one when it went through the law. The 2% floor tax deductions include unreimbursed employee expenses. So if you are a W-2 employee, let's say you have one spouse owns a business and the other one is a W-2, and the W-2 employee is bringing donuts to work every week, right, making the boss happy or whatever, those donuts are no longer a tax deduction, okay? And I know donuts don't typically add up to a whole lot, but for people like traveling salespeople, where they're W-2, okay, and they're paying for their own flights, they're paying for their own food, and they get their wages, you know, to pay for that thing, they no longer have a tax deduction. Their tax bill, oh gracious, their tax bill is skyrocketing through the roof because they no longer can take this as an expense. Okay, so the comment here is if your company will let you go 1099, go 1099, right? Go become a contractor, forget this W-2 stuff, right? Go become a contractor if your company will let you, so you can get the tax deductions, okay? Now the other thing that they kind of snuck in there, the 2% floor includes the fee that you pay your tax preparer if you don't have a business. So another good reason to have a business, right? Because if you have a business, the reason you have a CPA is because you have a business and they have to prepare the business taxes. That's why you have a CPA. So always something to watch out for. Couple of other little things here. So the estate tax basically doubled. It's now, as of 2019, it went up to 11.4 million. So as you know, I don't know how many millionaires we have in the room, but something to watch out for when you go to pass away. Make sure that you're working with your estate and trust teams to make sure that you're not over that limit. Child tax credit, we talked about that.
Per person, huh?
Per person.
24.
11.4 for 2019, it went to 11.4 per person. Yeah. Child tax credit, you know, we talked about that, it doubled. This is a big one that, you know, is hitting some people, not hitting some. This is your first mortgage. If you have a mortgage on a property, this is your first, you know, your primary mortgage on whatever home. And this is for your personal residence. So if the debt is over $750,000 on December 31st, you may or may not be able to deduct all of the interest on the mortgage, okay? Now, that one wasn't too much of a shock. We were kind of expecting it. The one that was a shock was the HELOC rules, okay? So HELOC is typically when you take out a second, you're doing it's home equity line of credit, right? You had equity in the home, you're pulling it out. A lot of people were using them to buy a new car, pay off credit cards, buy TVs, you know, whatever it was that they were doing with the money. Some people were pulling it out to invest in the market and taking the double deduction. Before 2018, this was all above board. This was all good, okay? 1118, they killed it. Absolutely killed it. So if you have so you can have up to $100,000, but you can only deduct it on your Schedule A, you know, your personal tax return, if you did something to your house, right? So for example, if your roof was damaged, you know, we had a lot of hail and storms and whatever, roof was damaged, you used the HELOC to put on a new roof, totally good, right? Up to $100,000. If it was $150,000, you can only deduct 2/3 of the total amount of interest you paid, all right? If you use that $100,000, there's a little way to get around it. If you use that $100,000 to buy a new rental property, you can, if your mortgage lender will let you, put the address of that property on the statement, you can deduct it under the rental property, okay? Yeah, but there's a lot of, you can hear if, right? So if it's done properly, then you can do it. So If you know anyone, if you're hearing people that have HELOCs, mortgage interest, higher numbers, have them double check with their CPA. Obviously that can cause problems as well. Now this one was kind of fun. So the ACA, this was the Affordable Care Act, the ACA, this was the health insurance, mandatory health insurance, 2018 versus 2019. So in 2017, right, if you didn't have a health insurance policy that met the ACA requirements, you were gonna pay the penalty, period. That was the deal, okay? 2018, Trump came in and said, this is ridiculous, don't like it, get rid of it, but the government couldn't move fast enough, okay? So what the government did was they repealed it, you can see me doing air quotes, right? They repealed the ACA, all right? But they only repealed it if you met one of the special exemptions. Now, the cool bit about the special exemptions that they put in was that one of the exemptions basically said, I can't afford it. Yay! Nobody can afford it, right? And they weren't having anyone double check, can you afford it or not, or whatever, all right? Yeah. So in 2018, as you're, right now we're starting to work on filing 2018 taxes. If you did not have an ACA compliant plan and you were thinking, hey, I'm gonna get hit with this penalty, double check and see, could you afford the health insurance? Because if you couldn't, you have a way to get out of the penalty, okay? So there's some cool things about 2018. 2019, we're going to see that coming up. In 2019, it was flat out repealed. Done. We don't care if you have it. We don't care if it meets the ACA requirements. We don't care. There is no penalty at all for 2019. So 2018 is kind of that weird little middle year, the little middle child there. Any questions on any of this? No.
What if you have coverage for just part of the year 2018?
Yeah, so you'd have to look at the exemptions, right? Because technically, if you did not have full year proper coverage, you get the penalty. But as long as you meet one of the exemptions that's listed, you should be good. So.
Believe me, here in Arizona, you meet the affordability exemption.
Okay.
Okay?
It's very expensive, the health insurance. So it's good that they put in that new change. So perfect. Okay, 2019. This slide is way too tiny and I should have made it two. I'm so sorry. So let's start with the business items. All right. So one of the things we kind of touched on just a little bit. You had asked, how do we reduce the income before it becomes QBI income? Okay. Paying your kids is a fabulous way to do that. All right. So if you own a business, depending on the type of business, depending on a couple of things, you can actually pay your child up to, in 2018, it was $17,500 a year, okay, $17,500, and so that's the $12,000 plus the 5.5 if you make a contribution to a traditional IRA. That has now gone up to 12.2, so we're really at 17.7 that you can pay your kids. So remember the story I was telling you about the couple that has the 10 children? They now have a deduction of $175,000 a year off their business income because they're paying the 10 kids. Okay? Now, kids have to meet some special requirements, okay? They've got to be older than the age of 7. You can't be paying a 2-month-old to shred your documents, right? That's not going to work. And the kid must have an actual job, but the job could be sweeping the shop floor, they could be picking up your files, organizing. Older kids can do things like work on your Instagram account, work on your Facebook account, right? Build up your social media, right? These are all available jobs to children.
Do you have to document that like an hourly time card, or is it,
You are
can you make it as
supposed
a
to
salary?
you are supposed to have documentation. That is correct. Now, the really cool bit about it, though, okay, so let's go to documentation for a second here. And we just happen to have an expert on this exact topic. So, Dave, I'm going to ask you, okay, if I wanted to hire a professional, top-tier social media expert, okay, what is like an average hourly rate?
You're gonna probably $40 to $60 an hour.
Okay, and you are allowed to pay your kids at the rate of a professional, of an expert, okay? So, this is really cool, all right, really, really cool. So, you're not talking about, when our parents used to pay us, and like, yeah, sure, here's a quarter to go, like, do the entire lawn or whatever, right? You are literally talking about you can pay your children at the rate of a professional, whether they are a professional or not, all right? So when you're talking about tracking hours, yes, I think you should do that, because if you get questions, you're gonna wanna have those records. It's just like your mileage records, right? You wanna have that backup, okay? But as long as the kids are doing proper jobs, okay, it's good stuff. And of course, depending on where you live, the last quote that I got from a presentation was in New York City, they're paying $120 an hour for that type of work. Okay, yeah. So the kids that live in Manhattan, that have with the parents, and the thing, we need tax deductions, and voila. Okay? Yeah. Yeah, we all need to go on social media because we're not in the right professions here at all.
What's the upper age limit of the child?
So depending on the type of company, and that's kind of why I didn't mention it, if you're a Schedule C sole proprietorship, the upper limit would be 18. It gives you some special tax deductions if they're 18 or lower. But if you've got kids in college, right? We have a lot of parents where the kids are 20, 25. They're going to get PhDs, whatever it is. You can pay your child just like any other person, right? You can pay any person anything you want. It just means that the kid is going to have to file a tax return, pay income on the tax. But generally, if they're 25, even if you're paying them $40,000, their tax bracket is maybe 10 or 12%. If you're in the 35%, it can still save you quite a bit of money, right, on the split in the family.
And
Okay.
does this not work for grandchildren?
Correct. It does not work for grandchildren. It's got to be your direct child. Yeah. Good question. Okay, so we do have some QBI threshold increases, but that's the stuff that you can't really see, so please ignore that. Oh, no, these are the tax rates. I'm sorry, that's this. You can see it went up from 157.5 to 160.700, so little bits of adjustment. It's your typical inflation adjustment, okay? It kind of cracks me up. They say, yeah, we're going to give you an inflation adjustment. They do it by 2%. I'm like, inflation was like 4 or 5. Come on, let's try and work this out a little bit better, please. We do have some increases in the 401k maximums, as well as the IRA contribution maximums on the personal side. So now, if you are over, I think it's 60 or 60, I think it's 59 and a half?
59 and a half.
59 and a half, thank you very much. If you're over 59 and a half, you can now put into a 401k plan, gracious, up to $25,000 every single year into the 401k. So some really nice options there, and 401ks from the standpoint of setting up retirement plans are nice. I don't want to say completely basic and simple like a traditional IRA, but they're also not as extremely complex as pension plans or some of the more larger type plans. So $25,000 a year for a pretty simple plan is a good amount of money.
Actually, I think it's 50. Let me confirm that.
Is it 50? Oh, thank
Yeah.
you. Thank you.
59 and a half is where you get penalized.
Where you start getting penalized.
Yeah, if you're below 59 and a half.
Yeah.
By taking
I think you're right,
distributions.
actually. I think the catch-up is 50. If anyone has any questions on that, feel free to send me an email afterwards and I will get you the exact age on that, but I think you're right. I think it is 50. Thank you. All right, personal side. This one is actually pretty big. If
Yeah,
you
it's 50
have-
and over.
It's 50 and over.
Mhm.
Thank you for the confirmation. Appreciate that. So this one is actually pretty big. You are going to see anyone who wanted to get divorced is going to do their damnedest to actually be divorced by December 31st, 2018. Okay? And it's really going to depend on whether you're the person paying the alimony or the person receiving the alimony in a divorce settlement. Okay? So previous to 1/1/19, right? So this is now, we're done. Okay?
Too late now.
Too late now. Whatever you did, all right? So any divorces that were finalized by 12/31/18, the person paying the alimony got a tax deduction. The person receiving the alimony picked it up as income, okay? Yeah. Starting 1/1/19, they're kind of giving it a few months here, so you have we have a brand new married couple basically in-house here, so they're like, no, let's get together, we're not doing divorces. It was really cute. Anyway, so the IRS has given a few months here at the beginning of the year for 2019 because, divorces unfortunately are not typically fast kind of things, right? They can drag on for months and months and months. So in this interim period, it's typically the first 3 months of this year, as long as your divorce documents, if you have a standard agreement, something that's been agreed to by both parties, you can still choose, is the alimony going to be deductible, not deductible, right? So if the parties are willing to work together, you can actually come out with some better tax outcomes. But after this window is closed, alimony is no longer deductible, that's it, you're done, right? And it's not taxable income to the person receiving it, all right? So it's basically become a penalty for getting divorced, okay? Yeah. So that is actually impacting quite a few divorce cases that we're seeing, right? Is, maybe we should just be separate for a while, like it's really changing the outcome of divorce at this time. We talked about, the indexing for inflation, the tax rates, and I'm so sorry about it being a little fuzzy here. Tax rates, the brackets went bigger, right? So the dollar amounts of each bracket, when you're being taxed 10% or 15% or 20%, those have increased in size, as well as both on the business side, the C corporation side, as well as the individual side. And of course, as we talked about, the ACA penalty is 100% gone, out of here, okay? So really good there. So, strategy. It's all about strategy, right guys? If you don't have strategy, you will pay lots in taxes. Definitely want strategy. So our firm offers a specific strategy. It's a group of strategies. We call it our Drop My Taxes program. So if anyone needs tax strategy, of course, I would be happy to help. We saved last year $56 million for our clients, over $56 million last year. Makes me pretty happy. If you guys have any questions, of course, you always know where to find me. Anything else? Any questions? No? Okay, you guys were fabulous. Thank you so much for giving me all the questions in the meantime.
Yeah,
oh,
one
please.
quick.
Yeah, go ahead.
2025, you said that it
Sunsets.
could revert.
Mm-hmm.
You think it'll stick?
Oh, that's a tough question.
Because they'll have its choice, right? When it gets to that point, they'll
They'll either
evaluate
continue it
how it
or
went,
not.
and they may just say,
So let's put it this way. What I have seen, so I've been in the tax world a little over 17 now, 18 years. Every time they make a rule and they're like, okay, it's gonna sunset, we're gonna cut it off, right? But when it gets there, they're like, well, we're gonna give it 3 more months, we're gonna give it 7 more months, and then by the time they're like already in the next year, almost done, they're like, never mind, we'll just leave it. So
that's kind of what I'm thinking.
yeah, I mean, do we really think it's gonna sunset? Now, of course, we have a very strange political environment right now, and I try to stay out of politics, right? Because from my standpoint, from the tax code, it is what it is, what it is, right? Whatever they wrote is what it is. I don't really care who's in politics or anything else, because it is what it is. And they could change all of this tomorrow, right? When they first started promoting this change, this massive 60% change that happened in 2018, it literally got passed in like 2 months. Like nobody read it, everybody was like, oh, sure, let's just sign some new tax laws, right? I mean, it's very just kind of like, oh, okay, and so even now, as you heard, we're going backwards on the QBI. Well, we have to undo this piece because that doesn't make any sense over here. Now we have a court case over here, right? So anytime you make these massive, massive changes in the tax law, something else is gonna come out, right? Something's gonna bubble through a crack somewhere. So, are they gonna stay exactly the same as they are now? Highly unlikely. Right? But are they going to stay 80% of the 60% that changed? Yeah, I'm a big fan of the 80-20 rule, right? Things normally stay about where they are. So